Good afternoon, everyone. Welcome to our first online event of ways to reduce your Thai personal income tax. Even though our modern medical advancements have helped extend life expectancies, the Grim Reapers is at best differs, certainly not prevented. Tax, on the other hand, can, to varying degrees, be either deferred or exempt. MBMG's presentations will look at legitimate ways of minimizing personal income tax in Thailand through several allowance and savings. And if you have any questions, you can leave in the chat box. Answer will be we will answer your questions during the Q&A sessions. All right. Without further ado, please welcome our keynote speaker, James Fraser and Kun Nam. Stage is yours. Hi, James. Hi, Kun Nam. Are you there?
Okay.
Why we cannot share the screen?
Hang on. Yes.
So we can see here. It's hostess. It says hostess disabled the screen. So
Can you click it again?
okay. All right. Okay, welcome everybody here to the webinar by MBMG Investment Advisory. And thanks, Jen, for the introduction. I've been in Thailand for 27 years now, and Nam has been working at MBMG 10 years. I've been 5 years in investment advisory. So today we're talking about how to reduce your personal income tax. And if you see down there on the left-hand side, if you have any questions, then you can send them to info@mbmginvestment.com after the event. So very happy Chinese New Year to everybody. And now we'll just start here on our first slide. So basically the definition of the person of a Thai tax resident is a person who's been here for 180 complete days. So that's 182 days if you include the day that they arrive and the day that they leave. And they have to pay tax on all the income that they earn in Thailand, as well as any income that they remit into Thailand in the same calendar year as they earn it abroad. So Thailand does not tax worldwide income as many other countries do. It's only the income that you actually spend in Thailand. And if you bring it in here the following calendar year as early as possible in that year, so it can clearly show it was earned in the previous year, then there shouldn't be any tax to pay on it. For a non-resident, a person that hasn't been able to stay here for 180 complete days, then they only have to pay tax on the income they earn here, not what they bring into the country. However, if you work here less than 180 days, but you have a work permit, then you will be considered a Thai tax resident because you will have a Thai tax ID and you will pay tax in the same way as a tax resident. So I think the key point here is for people bringing money into the country, you remit it in the following calendar year. And people who don't have a Thai tax ID and are considering to have one, they should seek advice first regarding their financial situation. So the point of this talk, well, certainly one of the points at least, is that we're trying to find ways, and we'll show you how you can try to reduce the money that you have in the highest tax bracket, whatever that is for you. So if you're over $1 million, then you want to reduce the amount that is taxed at $1 million baht or over, which is at the 25% level. In Thailand, the tax is accumulated. So Once you reach 1 million, anything over that is 25%. Below that, 750 to 1 million is 20%. Anything over 2 million is 30%, and 5 million, 35%. So the more deductions and allowances that you can use, the lower the higher part of your tax bracket will reduce. And that's what we're targeting to try and achieve today for all of you listening here. So Nam, she has looked at the tax deductions in quite a lot of detail, which is one of the jobs she does for people here, advising them on what they can do, and she also helps people to submit their tax filing online. So she will look at the general personal income tax deductions. There's 3 general and there's some more specific ones. And then I will come back to look at the personal business expense deduction. This is if you have your own, should we say, sideline business that you do besides your work, where you can actually claim for a degree of expenses. And then Nam will talk about some of the investment opportunities that there are to save tax. This includes life assurance, which is one of our favorite ones, just because it's such a simple type of Thai product to do, a defined savings plan. And then she'll also talk about the quota, which they allow in Thailand for retirement mutual funds, that's RMFs, Provident funds, which the work normally matches with the employee, and the super saver funds. So those 3 funds are all part of the same quota. Life assurance is separate. And then after that, I will come back to talk about the other taxable incomes. So we have gains that you might make on property, cryptocurrency, private company share sales. So these are other incomes that you may wish to know about, that have what we might say elsewhere as capital gains tax, but it's not really called that in Thailand, because you can either usually pay a withholding tax, which is final, or it just becomes as income tax, such as a private share sale. So I'll explain that later. And finally, we'll come back again to bringing money into the country, but this time focusing on pensions and also the double taxation agreement that Thailand has with most countries. Many of them are very similar. And then we'll open the floor up to Q&A. So now we'll start first with the personal income tax deductions, which are the statutory allowances in Thailand.
Okay, so the general income tax deduction, the more you have deduction, the less tax you pay. Is that right?
Yes.
Okay, so I want to focus on the first 3 deductions. These applies to all individuals who is employed by the Thai company. And the expense allowance, the revenue department allow you to deduct at 50% of your total income, but not more than 100,000 baht. So if you have more than one type of the income, according to the categories of the revenue department, you have to double check if what is the expense for those incomes. But this is for the salaryman, the one who employed by the Thai company. And again, self-allowance, it is just fixed 60,000 baht. Social security is for all the employees. It will be deducted from your salary, 750 baht every month. So altogether it's 9,000 baht. But last year it was only 5,850 baht because of the COVID. So the Social Security wants to reduce the contribution down. Next one is the spouse allowance. It is 60,000 baht. You can claim for spouse allowance only in the case that your spouse doesn't have any income only. Prenatal care and child delivery allowance. This one is quite new because the revenue department has just approved this in 2018. The maximum you can claim is at the actual amount that you paid, but not more than 60,000 baht. Let me give you an example. If you have, if the total bill that you pay for prenatal care and child delivery is 65,000 baht, and you get the support from your company 25,000 baht, so you can claim for the tax deduction only 40,000 baht for this deduction. Next one is the child allowance. It is 30,000 baht for it is 30,000 baht per child. But for the second child who was born in 2018 onwards, it will be 60,000 baht per child, and it's no limit as long as they are your biological child. Let me give you again the example. If you have two children, the first one was born in 2015 and the second one was born in 2019. When you do your tax filing, you can claim for child allowance, the first child at 30,000 baht and then the second child at 60,000 baht. So altogether it's 90,000 baht that you claim. And if your husband or your wife also have an income, he or she can do the same tax deduction on child allowance as well. So yes, so this is the only deduction that the revenue department allow you to claim twice. For parents and spouse parents allowance, we do not, it's 30,000 baht per person, but for foreigner, we found that it might be difficult for them to prove that their parent has less than 30,000 baht income a year.
Yeah. Because the income has to be no more than 30,000 baht per year. So I think that's probably highly unrealistic.
And disabled person support. If you have this person under your care, you can get another 60,000 baht per person for tax deduction. And this is just for someone who have home loan. The interest rate, the interest amount that you paid for the home loan, you can get tax deduction at the actual amount or not, but not more than 100,000 baht. And for the donation, you will get maximum tax benefit from donation up to 10% of the total income, but after all deductions.
Yeah, for the home loan, we understand it is quite difficult for foreign nationals to be able to get that, but there are actually now one or two banks that do lend money, albeit at a higher interest rate, such as UOB, and I think there's another one or two, but the money is actually coming from Singapore, not from Thailand. And in many cases, the mortgages actually has to all be guaranteed by the Thai partner. So it's rather, unusual to find foreigners with loans. So I just want to delve a little bit deeper into the expenses for a small individual business. Nam mentioned that there's a company deduction of 100,000 baht per employee or for freelance who are also working for a company. And on top of that, there's also the expense deduction if you do your own small little business. So this is not actually an incorporated entity. This is actually just you at the weekends or in the evenings selling something online or some other type of business. And providing you put all the sales through as your income, you can claim 60% of the expenses as a deduction. But you can claim actually more than 60%, but unfortunately you have to have all the receipts and they all have to be really correctly written out with the Thai tax ID, with your address, which has to be exactly the same as what the revenue department has. So that's it's pretty difficult, especially if you're really busy. What we actually try to recommend, if it's possible, is that you actually open up a small company. You set up a small company, which is not so difficult to do, and is something that we actually provide, that service to people. And you can book a far more realistic level of expenses. If you think about it, 60% expense is not realistic. It's going to be more like 80, 85%, depending on what your margin is. And a small business can also get a number of tax incentives. And also, perhaps the most important point, since 2018, the Thai government passed legislation whereby the banks have to report to the revenue department when there's a high level of transactions. So, because this is quite important, we've gone into a little bit more detail here. If there's 400 inward deposits in 1 year, and that reaches 2 million baht, then the bank has an obligation to report you to the revenue department. Or if there's more than 3,000 deposits of any amount, so they could just be small amounts, then they also will report you. And if Revenue Department find that the name on that bank account hasn't been submitting that income on their annual tax return, then you'll have a major problem. So that's another reason to incorporate your company where the expenses will be properly kept, ledgered, and everything will be done, properly. And that's definitely a worthwhile thing to do, and it gets you on the ladder of having a company. But again, I know that there's some restrictions on foreign ownerships, but it just depends. There's still ways and means to do things. So now we'll go back to talk about the first of the investment side of the, should we say allowances or deductions. This is basically split into kind of two things: deductions for expenses, and then you have on the other side of it the investments you make for savings, which is the Thai government trying to encourage people to save for retirement, I guess, so they don't have to spend as much money on us as they would otherwise. So first of all, the life assurance one now.
So as I mentioned previously, the general deduction, if you are single and employed by the company, the maximum you can get deduct from the general deduction is only 169,000 baht. So I think that's not enough. So you need life insurance in order to help you decrease the income, so you get paid less tax, right? The condition for the life insurance is that the premium that you pay to the life insurance can be deducted for tax. It is at the actual amount, but not over 100,000 baht. But that life insurance has to be like a policy from a Thai life company, and the sum insured has to be in Thai baht only, and the term of the policy has to be at least 10 years.
Yes, that's right.
And when people looking at life insurance, they might think that it is like a term insurance
with a lot of protection.
Yes, it's the protection.
But this is not a lot of protection. It's defined savings more. Right?
Yes, this is another kind of life insurance that the function, when you take a look at it, is the defined saving plan rather than the protection.
Yeah, I think it puts quite a few people off. This type of product, because I think it's never properly been marketed. Actually, it's not really a proper protection life assurance, whereas you get multiples back on what you pay. This is something where the premium you pay, which is between 3 and 6 years, you pay 100,000 baht for 3 to 6 years, and at the end of 10 years, you get back all the money you paid in, and you receive interest every year. If you paid in the maximum of 100,000 baht, you receive back about 10,000 baht every year. And you also save on the tax. So if your marginal tax rate was 30%, then you're also saving on 30,000 baht plus the 10,000 interest. So you're getting back 40,000 or a return during those years you pay it back, which is quite high. So that's why we like this. It's simple, it's easy to understand. It's once every year, the same amount of money. And it's just, it's really like a brainer for anybody. That's a no-brainer for anybody who's going to be here for, at least 6 years or 5 years during the time they pay it out, during the time you have to pay the premium every year. And then the last few years, the last 4 or 5 years, depending on how many premiums you've agreed to pay, you don't have to do anything. You can just sit back and wait for them to send a check.
And the total return will be better than you put the money in the fixed deposit account.
It is actually.
And all the return that you get from the life insurance company, there's no tax.
Yes, that's another important point as well. There's no tax on the interest, or if they pay a bonus at the end of it.
And before we finish this slide, if your spouse again doesn't have any income and he or she has a life insurance, you can claim at the maximum of 10,000 baht.
Well, it's better than nothing.
Yes. Okay. So we talk about general deduction already, and then life insurance that can help us.
Yes.
Then this one is about the investment for tax saving. They are all together 4 plans for the people who employed by the company that can buy. Let me start with the last one, the annuity plan. We do not recommend this one much. It is because if you don't plan to retire in Thailand, so it's not worthwhile to
Yes.
invest in this kind of plan.
You have to wait until you're 82 years old. It's 30 years of payments, and they're supposed to start at 52 and end at no more than 82.
And you won't get the lump sum.
No, and there's no lump sum. It's a one payment annually.
Okay. Next one for people who employed by the Thai company, you can check with your company if they have Provident Fund or not. If they have, the law allows you to contribute to the Provident Fund at 2 to 15% of your salary, based on your salary only, not including bonus or other allowances that the company offer to you. This is interesting because Provident Fund is a co-contribution plan together with you and your company. For example, but this is just the sample, but you better check the condition with your company again. For some company, they might let you contribute to the Provident Fund at 8% because you have been working with them for 8 years already. And then they will match the contribution for you at 8% as well. So it means that the 8% from you, you get tax deduction, and you get another 8% from the company. So it's like a free money every month. Okay. So, and then next one is SSF. SSF is a mutual fund that we just have last year to replace the LTF. The maximum you can buy is 30,000% of your taxable income, but not more than 200,000 baht. It is, so I think it's suitable for someone who is younger than 46, 45 years.
About that, yeah. The key is you have to pay in, well, you can pay in one time, but you have to wait 10 years to receive the money back. So it's a full 10 years. You know, but an RMF, it's 55 years of age that you can sell all of them, providing that you've been paying at least 5 years and you start at, you know, say at least 50.
Yes. So for SSF, I think it's suitable for the younger person. And RMF, it is again 30,000% of the taxable income, but sorry, is 30% of the taxable income, but not more than 500,000 when you combine all of this plan together. So for someone who 30% of their income is more than 500,000, and they are like and they plan to retire in the next like 9 or 10 years, we advise them to invest in RMF at 500,000 baht at the maximum.
Okay. Yeah, I think one of the keys to remember on the RMF and the SSF Provident Fund is the 500,000. Where clients tend to make errors is that they go over that level. They put it 500,000 in RMF, but then they still have a Provident Fund that takes it over that level. Basically, I think what we were saying earlier about the age. So if you're 46 years of age, then there's 2 reasons why you might want to invest in an RMF rather than a super saver fund, an SSF. Because if you invest at 46 and you only have 9 years to wait for your lump sum payment until you can take it out if it's an RMF. If it's a super saver, you have to keep to 1 extra year, 56. So, and every additional SSF you buy, so if you buy one at 47 years of age, 48 years of age, 49, you have to keep it 10 years. But for the RMF, when you buy it, say 46, 47, 48 years of age, you can still withdraw all of them at the age of 55. So the older you get more, you move towards that 55, the less number of years that you need to hold it. There's also a considerably more choice of RMF fund than there are of Super Saver Fund. Super Saver Fund has only just got going, and it's basically more or less, besides 2 or 3 of the ones we've seen so far, it's based on the old LTF structure, which is mostly Thai equity and fixed income. However, the RMF are really quite varied. They have gold assets, foreign feeder funds into larger, well-known foreign funds, and several different choices, actually, even like US mortgage security, the whole wide range of choices. And I just want to make the other point that's related to that. If you do have a Provident Fund and you're paying more than your employer, so if your employer is paying 5% into it, but you're paying 10%, there's not really a great reason to do that, because Provident Fund is also quite limited in choice. Again, it's normally Thai fixed income with a with a portion of Thai equity in some proportion, depending on what you take as your risk level. And that's quite limited. You're limited to just Thai baht exposure, whereas you shouldn't really pay any more into a Provident Fund than what your employer pays for you. So it should be matched exactly 5%, 5%, or 10%, 10%. And the remaining amount you can just invest in an RMF. It's all part of the same quota. The tax deduction, the tax benefit is the same. This is just a final case study to make sure that you fully understand it.
Okay, let's start with Mr. Smith. He has been working in Thailand for 15 years, and during this 15 years, he has been investing in his RMF, LTF, and SSF fund. Then he decided to retire in Thailand at the age of 55. After the retirement, his income after the retirement are Provident Fund, the redemption from his LTF and RMF units, and the pension from UK that he will bring into Thailand. Do you think all of these are liable for Thai tax income?
Well, they certainly all fall under the Thai tax regime. A Provident Fund, if you take it out at 55 years or older, you don't have to pay any tax on it. Yes. If you redeem your RMF at 55 and you followed all of the rules correctly, then you don't have to pay tax on the RMF as well. On the SSF, you have to wait a full 10 years regardless. The pension from the UK, this runs into a little what we're going to talk about later. In theory, you shouldn't have to pay tax on it. However, in reality, if you bring it into Thailand in the same year that you had it paid to you, then you probably will have to pay tax on it. It's better to bring it in the following calendar year. So just to talk a bit more on that pension there, remitting the pension into Thailand. And this is also concerns, this also might concern other forms of income, but let's just use the pension as an example, because it's quite a good one. Well, first of all, you're supposed, in theory, you can refer to the double taxation treaty with your country, but almost all of them are the same, or they don't mention pensions at all, actually. But as it happens, pensions do, in most cases, fall under or they are subjected to the tax of your home country or the source of the retirement pension, and therefore, in some rare cases, they have withholding tax taken off at source. But in many cases, they don't have tax taken off. And the reason for this is, and this is like, for example, the UK state pension, is because the personal allowance in the UK is £12,500 a year that you can earn without having to pay any tax. Now, the pension amounts to around £9,000 per year. So it's below the personal allowance that the UK has for its citizens, and therefore it doesn't take any withholding tax off. And that actually, when you bring the money to Thailand, that can present a problem, because it's difficult to explain to the revenue department that it actually has already been subjected to the UK tax regime, but there's no withholding tax. It would actually be better if there had been a withholding tax, perhaps. to show that tax had been paid. So the Thai authorities under the DTA, where the DTA says that the tax should be paid in one country or the other, they will want to tax you. However, this is only if you bring the money in the same calendar year as you receive it as a pension. So the best way to handle this is simply to bring it in the following calendar year, and as early as you can in the new year. What you've got to show is, if you're ever questioned on this, and the time you might be questioned is if you are applying for Thai tax ID, which a number of people want to have. And that's, if they look at your statement, you have to show that pension has gone into an account, and that account hasn't been used for other things between the time you receive the pension and the time that you bring it over to Thailand. So, for example, if you received the pension in November, but you didn't bring it over to Thailand until the following February, but then in January you had another balance coming into your statement, then how can the Revenue Department know that January one is not your pension as well, and the amount that you're taking out is just the pension you got in January? So in that case, you couldn't prove that you weren't taking out the pension earned in the same calendar year, and the Thai tax authority would want to challenge you and try to make you pay a tax on that in line with your income tax. So what we suggest is bring the money in as early as possible following calendar year, and always ask advice before you go to register yourself for Thai tax ID if you are a retiree here in Thailand, because they can ask to see your overseas bank statements. Now we're looking at other taxable incomes in Thailand. One of the main areas of this is what we know elsewhere as capital gains. In Thailand, they don't really have capital gains tax as such. It's more just personal income tax. And the Thai Revenue Department has tried to make it as easy as it can for people, in that they have various withholding taxes for different types of capital gains. So for property, as you may know if you've ever sold a property, is that you can actually pay for the tax on your gain at the land department on the day of the sale. And they can work this out, the withholding tax, based on a certain formula. The formula is just simply based on the number of years, basically, that you've lived in it, and the expenses that you can take off, because the less time you've lived in it, the more expense you can take off. And that withholding tax is the final payment. So it's actually very, very kind. And that withholding tax assumes that you don't have any other income. So, I mean, it's a really good taxation policy, to reduce people's tax. Stock market gains, capital gains tax-free. Cryptocurrency gains is also 15% withholding tax on realized gains in Thailand, and you have to pay 7% VAT as well if you buy products. You can't kind of avoid that. But again, it's a withholding tax. So if your tax bracket on average was higher than that, you could just have that as the final payment. If it was lower, if you ended up losing by the end of the year on the cryptocurrencies, and your average tax rate was less than that, then you could actually possibly seek a rebate on the difference there. Now, the final one I'll talk about is the private share sale. This is the one we get the most inquiries on, because it's the one where our corporate advisory, can provide some input. And that is, if people sell the shares in their private company, because it's not listed on the stock market, they have to pay tax on the gain, and that gain is simply personal income, just the same as a salary or any other type of income. However, there's ways to try to reduce that by lowering the sale price of your company, by taking out any cash or other income that you might have in it as a dividend to yourself first before you sell it, or as a bonus. Now, the dividend tax in Thailand is 10% withholding tax, so you would lose 10% on that. as opposed to paying personal income tax if your tax bracket was 35%, supposing you'd made more than 5 million baht profit on your share sale. Or you could book as a bonus to yourself, and then the company would be booking that as an expense as well. So there's an optimal level for everybody what they should pay for the sale of the shares versus dividend and bonus. And that's quite a topical issue when people come to selling their company. Okay, now we'll just talk about this online banking, because this is something we've seen a lot with the COVID outbreak and people being stranded in other countries.
Yes, in the case that when you work here, you have a Thai bank account, and that Thai bank account, you use it for buying RMF, SSF for your tax deduction. And then you have to leave Thailand, but some of the investments still in the Thai bank and also the Thai asset management company. The best way before you leave the country is to go to the bank and make sure that your online account password and username and password are still active. So.
Yes, quite important, because we have clients that simply can't buy their RMF. And this is maybe one of the things you'll want to ask us in the question time, the rules on the RMF. But basically you have to buy each year. That's, in a super saver fund, you only have to buy once. But an RMF, you have to buy each year. It's one of the rules you have to follow. And if you don't buy each year, then you're going to have problems, and you could end up having to pay back the tax. So it's very important that if you leave Thailand, that you can still buy your RMF online, because the bank very rarely will allow a proxy to go in and buy it for you. We've tried for several clients and we've yet to be successful. So it just isn't something the banks are prepared to do.
Yes.
Okay, just the last couple of slides here before we open it up to Q&A. Here's some non-cash taxable income. I'll only really refer to one. This is just the only one here that really surprised me, or perhaps because I hadn't thought about it before, but there's a number of expatriates that negotiate a net package, a net payment to them. They don't want to know about Thai tax or whatever, even though Thai tax is actually very inexpensive, actually. I mean, they just want to receive a net, and the company ends up pays the tax bill. Actually, if the company is then writing out a check for the tax bill, that's actually taxable income as well. How it might be proved, especially if it's a payment, if it's, well, I guess if it's brought in from offshore, that's a remittance into Thailand. So, it's something that I'm not sure everybody's aware of. And these are just specials. The only one here to really mention is the shopping, only because it's happening, every year these days. And it's for last year, it was a maximum of 30,000 baht. The problem is you have to make sure you have your Thai tax ID and it is correct, and you present your correct address as the Revenue Department have in their system, and then there shouldn't be any problem to receive that. So this is the Q&A. Nam started off with a question here on the deadline for tax filing. And for physical hard copy, if you still do it that way, it's the end of March. For the online, it's end of June. Unfortunately, the online is still only in Thai language. It's a service that we do actually do, believe it or not. I mean, that's something that it is quite, it's not a very expensive service, but we still do it. And, what we found actually where we offer the most help is, what people perhaps don't realize is they have to open an account with Krung Thai Bank. I think starting last year, I think, because they won't hand out checks anymore. So, and for foreigners, there's a difficulty in using prompt pay. Is that right now?
Yes, because prompt pay is for Thai people only.
For tax purposes.
Yes, for tax purposes.
So every foreigner in Thailand pays tax has to open Krung Thai Bank. Is that correct?
I think the most convenient way is to open a Krung Thai Bank. But the second thing is you don't have to open the Krung Thai Bank, but you go to the bank, show the letter from the Revenue Department that you got tax return, and then they will give you the what they call e-money, the card like a
I mean, like a
debit card.
Bitcoin.
No,
Well,
like a credit debit card
Debit
where
card.
you can go to the ATM and
Right.
withdraw cash.
Oh, okay. Well, that's interesting.
But I don't think it's convenient if you have like more than 100,000 baht of tax return.
Well, they will have if we help them.
I mean, like to get
rebates.
the debit card. But I'm agree with you that the bank account is a lot more convenient because you can set up again online application through your mobile, and then you can transfer the money to the other accounts quite easy.
Okay. I just wanted to go back to the slide where I talked about expenses for business. If you do have a small private business, then you also have to make sure you register for VAT if your sales reach 1.8 million baht. So that's also another thing that sometimes people forget. Actually, you're supposed to be charged in VAT. The revenue departments, this is their area that they're trying to crack down on a bit. I think since I think the beginning of last year with the increase in online businesses and startups, they're trying to get as much tax as they can from these areas, and forcing people to register for VAT if they can figure out who's got these sales is also another a strike point for them. 1.8 million baht. So be aware of that as well. Okay, I'm going to open the floor up for Q&A now. If we have any, how do we know where the Q&A is?
Yeah, we have quite a lot of questions on the chat box as well. I can help you monitor the questions.
Okay.
Oh, okay, my camera is not on. All right. Okay, first questions we have regarding to from Martin. So regarding to the expense allowance, actually receipts bill required?
Wait, is this the expense allowance for the company employee? You don't need to have receipts. For the 100,000 baht, it's fixed. If it's for the business, personal small business, then you can have up to 60% without any receipt. 60% of the sales. If you want to include receipts, you can have more than 60%, but the receipts have to be accurate. Normally, that's quite difficult to achieve, for a small business, because you have turnover and you might be buying inventory on a daily basis. So that's what the reason they have a fixed amount of 60% of sales, which is doesn't require receipts.
All right, thank you. The next questions would be what kind of costs include on expense allowance and self allowance?
Well, the self allowance there's no receipts. No, self allowance is 60,000 baht fixed.
Yes, it's a fixed amount that an individual can get.
Yeah, that an individual can get. It's the same, say in the UK, like a personal allowance. It's not related to the receipts.
You don't need to show anything.
Yeah, and again, the company expense is also not related to receipts at 100,000 baht. You don't need to show any receipt for that. It's 100,000 baht it's not related to receipts. The only one related to receipts is the small business expense one.
All right. Now the questions are from the floor is that if we leave Thailand before 55 and keep our PF and RMF, will we be taxed in our home countries, Europe?
You might be actually in certain. I mean, there's double taxation between the two countries, but yes, if you leave before, it depends when you sell it, right? It's quite possible you could be taxed if you live in your home country, under because it's you have. I mean, certainly in the US that's the case, and but in Europe. I mean, in Thailand, if you follow all the years, all the rules, when you sell at 55 years old, you shouldn't have to pay tax actually, and under the DTA, you shouldn't have to pay tax, but it's different for each country how they would view it. In some instances, they will require you to pay tax, if so it really depends on each of the countries. We'd have to look at that in more detail.
All right, thank you. And another question from the floor: how would RD know about cryptocurrency gains, or would the crypto exchange deduct the withholding tax from your account?
They should deduct it. I mean, they're supposed to, yeah.
Okay. Another question from the floor is that Thai stock market tax-free gains. What about non-Thai stocks?
Well, non-Thai stocks, if you bring the money into the country, then you are liable to pay tax on it. If you have the money offshore or you send it off, then for foreigners, you'd only pay tax when you brought it back in again to Thailand in the same calendar year that you made that money. For Thai people, they can apply for various means to bring it out of Thailand, such as they have the QI, qualified investor, where you can bring out a certain amount of money each year, and the BOT monitors that. But that's for people with 50 million baht or more. But again, if you do it correctly, you don't have to pay tax on that if you bring it into the country in the following year that you make it.
Right. Right. We have another question from the floor about the tax deductible perks. Could you explain? Could you please explain on this? Perks, including HRA or traveling allowance or any other allowance given by the company?
Yes, there are different tax benefits. You maybe looked at that more than me, but there's a tax allowance for going up country. Is it 15,000 baht? There's a list. There is a list of other different tax allowances that you have for travel. That's correct. But that you can claim for an individual, yes.
Okay.
An individual type of business, yeah.
Okay, thank you, James. Another one is from Tim. He asks, IMF, you have to buy every year. Was not aware of, but they are still locked for 5 years. In any case, if every year the amount you pay to a certain IMF is okay to fluctuate, right?
So I didn't get the last part of your question.
It's about IMF, and basically you have to buy it every year, but you have still locked for 5 years. In any case, if every year the amount you pay to a certain IMF, is it okay to fluctuate?
Every year you have to buy the RMF, depending on your income. The 500,000 baht, or 30% of your income. That's the rule. But if you're not sure what to buy, you can buy a deposit fund or a cash fund to reduce your risk. But you do have to buy it for 5 years, and then after the 5 years is up. So you have to buy every year for 5 years. And then after that, you have to wait until you're 55 to be able to withdraw it out. Oh, the minimum to buy the RMF is actually, it varies for each fund, but by the law of the Revenue Department, I believe it's from 100 baht to up. But most of the RMF, they will require like 500 baht as the minimum. It used to be 5,000, but now it's 500 baht is what they charge. But by law, it's actually less than that. 100 baht is okay.
Right. Thank you. This question from Timothy Wong: is the tax submission deadline extended to June 30th, 2021 only for submissions online? Or if submission offline, when is the deadline?
Yes, submission online is 30th of June. The hard copy is still the same, the end of March.
Okay.
But it's actually better to submit it as soon as you can, because the sooner you submit it, the sooner the rebate, comes. So if you do it online, around this time, you can get the rebate, I mean, from the previous couple of years, within about 6 weeks. The longer you leave it, the longer it seems to take to come. So if you leave like the March one, sometimes if you wait until the end of March, sometimes it doesn't come till the end of June. I think they just get busier with more and more people, so the rebate takes longer to arrive.
Right, thank you. Another one is, could you please elaborate more on the IMF and 55 years automatic retirement payout? So, mean if you pay in at 52, you would still get payout 55, even though it might not have reached the full time period.
If you started to pay when you were 50, and you've already paid 1 year at least 5 years. So if you paid at the age 50 and every year for 5 years, then what you pay at age 51, 52, 53, 54, and 55, you can still take out. But if you start the first time at 52 or 53, then you have to continue to do that for 5 years. So you wouldn't be able to take it out, until 57 if you began at 52. So yeah, that rule of 55, you must have started to pay by the RMF every year from the age of 50.
All right, thank you. Another question from Michael. If your company provide you a company car, some amount to tax as income, if you get a car allowance that I believe 100% to income, how about allowance pay at home country need to add as income?
In the home country, I mean, in Thailand, it's an income, right? It's a non-cash income. If you have an allowance elsewhere, if you're not bringing it into Thailand, I don't see that would be taxed. I'm not sure I understood the question there, but tax allowance, an allowance for a car in Thailand is definitely income taxable. The same as any allowance, mobile phone, house allowance, college allowance for your children, they're all taxable income.
Another spin-off questions from about the Thai stock and non-Thai stock. So Xavier asks if gains on non-Thai stock brought in Thailand, not abroad, taxable?
If you bring the taxable gain into Thailand, you have to pay tax. Yes, you might still have to pay tax in the previous country as well. It depends on the double taxation agreement, but most of them don't include stock gains actually. So you would end up probably paying if that country took off money at source. But if you're a resident of Thailand, you should really only be paying, tax on Thailand. But if they took off like a withholding tax, like dividend withholding tax is quite common, or if they had a capital gains withholding tax, such as in the US, then it's possible that you would have to pay that tax, and when you brought it in Thailand in the same calendar year, you would also have to pay a tax here. It's possible. Yes, possible.
Great. I think we have a little bit more time, but I will give this like another two questions from the floor. So the first of the last question is, bonus paid by company is subject to different tax rate. You mentioned paying bonus / dividend first before selling the share in private Thai company.
Yes, that's right. That's basically, that's just to find a way to reduce the selling price of the company. So you might want to increase the expense of that company to essentially make it worth less. And you could actually pay the bonus to yourself. However, that bonus obviously is still subjected to income tax. So it just depends, how much the bonus, if it's what it's for. I mean, it's probably not any. It could be possibly no difference at all, actually. But it's just one of the options. I mean, the most likely one is dividend, because that's 10%. So that's correct. I mean, what he's saying there is there shouldn't really be any difference. but it would just all depend on how much salary he's earned during that year. Some people in a private company, they mark their salary down quite a lot, say, because they want to keep money in the company, and in which case, there might be, but essentially there wouldn't be any difference. It just depends on calendar year as well. So if you paid the bonus this year, but then and it was the end of the year and the following year you sold your company, then there might be some difference in the calendar year for the income tax. That's more what it's about.
Okay. Yeah, thank you. Another one from Xavier. It's actually he explained a little bit more on his questions. So he mentioned non-Thai stock. He bought a non-Thai stock in Thailand, for example, stock market from US, China equities. Are we taxable on the gains when we sell it back in Thailand?
Yeah, if you
as long as you don't bring it to.
Well, you buy in Thailand. You mean online, I assume, right? So, and then the money is being transferred to buy the stock in the other country. I assume that's from an account elsewhere. If it's not, then yeah, when the money comes back into Thailand, if it's in the same calendar year, technically you should pay tax. But most people would keep it on a platform or an account which is outside Thailand. They wouldn't transfer it out of Thailand on each share purchase and then bring it back. Normally, that's not the way it's done. You have an account offshore, and you just use that account offshore, and you might trade from Thailand, but actually you're just trading on that account that's offshore, and the money buys the stock, you sell it, it still goes into the account that you have offshore or the platform that you have offshore. And then you only bring it back to Thailand maybe once in a while, and you can usually afford to wait until the following calendar year. But if you don't, if you just transfer per stock purchase and you sell it and immediately bring it back to Thailand, then that is taxable income.
All right, I will have one last questions. One more questions from the floor. Actually, we are. I think we have 30 more minutes until we end the meeting here. Yeah. But actually, we have already opened up the microphone. So if anyone from the floor interested in ask the questions directly to James and Kun Nam, so you can do so as well. So I will read another questions on the floor here from that's you mentioned about RMF can be take out at 55 years if started to pay in not later than what we are 50 years old. What about LTF? What are the rules of the LTF?
Well, for the older LTF, that was actually 7 calendar years, which is actually 5 years. And the 7 years, I think, started to come into effect in 2016. Is that
yes,
right? So 16, 17, 18, 19, 20. So you can sell it in 2022 for those ones. That's the old LTF. So SSF started last year for the first time. And it's a full 10 years, not calendar 10 years. So if you see the LTF was 7 calendar years, so you could buy it at the end of December, and then you could withdraw it in the 1st of January in 5 years' time, and that would still be 7 years because it's the end of the 1st year and beginning of the 7th year. But in reality, it's only 5 years and a few days. But it's totally different for the Super Saver Fund, which is 10 complete years that you have to do. So the last LTF that was possible to buy would have been 2019. So you can actually take it out on the 1st of January 2026, would that be? 25, actually. 1st of January 2025, you can take your last LTF out.
Thank you. So do you have if any participant have any questions, you can unmute yourself and speak directly to the microphone.
Hi.
Hi, hello.
Xavier here. Thanks, James. Really useful. Yeah, great webcast. Xavier, I just wanted to clarify this stock thing. Maybe I was not clear on the chat. In fact, it's when you buy a stock or equity in Thailand, so via your bank, they are buying for you equities in China at the time or US.
Oh, I see. Through the stockbroker.
Yeah, exactly. And then, or the bank, yeah. And then when you sell it back, I think the bank told me there was a way to avoid the gains being taxable, but I'm not sure. Like, of course, if it's on a Thai stock, yeah, they will be tax-free, the gains. But if they are both in China, I don't know how it works.
From what I understand from my own experience of talking to the stockbroker, the way they have it set up is with a custodial offshore, and they're always very careful not to, or to try and avoid bringing it in within the calendar year. I mean, one of the stockbrokers I know, which is they use, I think, custodial JP Morgan, and they keep the money offshore. So they might sell the stock, but they actually keep the money in the custodial account until the following calendar year, and that's what they should be trying to do for you. Does that sound familiar? Or,
I will check.
Not?
No, not that familiar, but I will check. In fact, it's bank. It's directly a bank in Thailand, like Hong Si or SCB, or so. I don't think they do.
Oh,
these kind of things.
Are you talking about the foreign feeder funds or?
No, just equity funds outside when you buy shares through a bank in Thailand.
Oh, equity, but actually, the Krungsi, I think it's a foreign feeder fund. It's actually a Thai registered mutual fund, I suspect.
Yes, I think it's probably it is. Yeah.
Yeah, but they buy the China stock. No, that's fine. I mean, that's that's a Thai mutual fund. And
as long as it's a Thai mutual fund, there is no interest on the gains, right?
No, it's capital gains tax free, so that's no problem.
Okay.
I mean, you're buying a managed fund, which then goes to buy the stocks. You're not actually buying the stocks directly.
No, yeah, it's a managed fund.
Yeah.
Except the dividend, right?
Yeah, dividends are taxed, but these withholding tax, but these 10%, but
the final tax.
Yeah.
If you don't want to claim it.
That's right, but Thailand has a withholding tax of dividends, which you don't need to put into your annual account because it's a final tax. So the only reason you would declare it is if your average taxable bracket was less than 10%, which I'm sure is
right. Very clear. Yeah, that's clear. Thanks.
Okay.
Yeah, hello, it's Michael speaking. Good afternoon. I have a small question about some allowance. I mean, of course, let's say if you have a car allowance, let's say from the company paid to you in cash, let's say, take an example, 20,000 baht, of course, this comes as an income. If the company provides you instead of that a car itself, how much from the car you really have to put in as an income? Is there some clear rules, 25% or 50%, or the real leasing loan finally, or?
I'm not sure actually that there is. I mean, it's a company expense. There should be some formula for counting it. If the company doesn't provide that, which I know they usually don't actually. I remember a situation they actually normally don't try to quantify that. So no, unless the company quantifies it on your behalf, I think there's no way that they can be put in as an allowance. But that's an interesting question actually, which I'm not sure the answer completely. There'd have to be some way of valuing or quantifying that allowance. So I haven't. I used to experience that many years ago, and there wasn't any quantifiable amount to put in to enter for the tax return reform. But we can check that for you if you leave your name and address. We can find that out for you if you want to know. As far as I know, there isn't a fixed kind of formula for that. I haven't seen it anywhere actually.
Okay, thanks. The other one what I had was maybe not so clear in the chat too. I mean, I can take it as a real example. Myself, I'm working here in Thailand for a Swiss company, and our headquarters is in Switzerland. So in the past, or still now, I had a kind of, let's say, the Provident Fund and everything, not Provident Fund, pension fund, a kind of pension fund which was paid in Switzerland. So in the past, it was always paid in Switzerland. So of course, we never saw anything here. So that was also not taken as an income. But right now, they changed completely the term. So this Social Security, which still remain in Switzerland, is now paid out from Thailand. And of course, after it's paid out from Thailand, it's 100% income tax.
Right.
So, but it's still legal if the headquarters still company to pay it and it's not transferred back to Thailand. I think it's not need to be added in the tax. So
Yeah, you're going a bit faint on me on your voice, but if they're paying, you know, something that is outside of Thailand, it's actually taxable income, and you wouldn't get any deductions for that. The deductions are purely only for Thai saving instruments. That would actually be counted as your income if you're working in Thailand and not Switzerland. You know, if you're working all your time here. Yeah.
Whereas meaning if you have an allowance paid out in Switzerland, theoretically you have to put it also as an income here.
If you have an allowance paid in Switzerland for work that's related to doing in Thailand, technically you're supposed to pay tax on it, in theory, you know, but that's what it's supposed to be. Yeah, I mean, if anything related to your work you're doing here and you're not doing work anywhere else that could justify it, you're not going to work in Switzerland or doing anything there for a period, for a part-time or a few days or a period of time, and there's no way they could justify that payment for doing that, and you're only working in Thailand, then you would have to pay, you know, in theory, you know, I don't know how they would know about it, but if you wanted to declare that, you would have to pay tax on it, yes.
Okay, thanks.
Can I ask a question about the LTF, please?
Yes.
All right. So I've been filling up with the 500,000 since 2017 on LTF and RMF, and then with the new rules that you could not deduct LTF anymore, I stopped paying on that. So I have approximately 350 on two different LTFs. But I stopped paying that since I think last time was 18, as far as I recall, when they changed the rules.
Yeah.
Meaning I haven't paid for them. Will that have any tax implication when I'm trying to get them out?
If you haven't continued to buy them, you mean?
Yeah, because they changed the rules.
Yes. No, you don't need to. For LTF, you only need to buy one time. It's not the same as the RMF. The RMF you have to buy each year. The LTF you can just buy one time and wait the full period of time. Normally, if you go to the bank and try to withdraw it, they won't allow you to withdraw it before the time of withdrawal comes. So if you went to the bank today, but it wasn't to come due for another 2 years, they wouldn't allow you to take it out. So you don't have to worry about it. The rules for the LTF and the Super Saver Fund are much easier to understand than the RMF. They're just one-time payments, but you have to keep each payment for 10 years.
Right. Okay. Thank you very much.
Okay.
Do we have other questions?
Okay. Yeah, if people want to contact me, if we have people on the call, still, you know, the email is info@mbmg-investment.com. And the guy that wanted to know about the car allowance, you know, there will probably be somewhere. I just haven't seen it. I mean, car allowances are definitely tax. They should be, you know, they should be liable to tax, but I just haven't seen it when it's the car that's given rather than the amount. So, you know, there probably will be something.
All right. I think if we don't have any other questions, so we can conclude our meeting this afternoon.
The question here is shown on my screen about money being paid out to termination of employment. You know about that, Nam. You were talking to me about that the other day, don't you? If somebody receives money on termination rather than resigning.
Yeah, the first 300,000 baht won't be included for tax
calculation. Yeah, it's not. So the first 300,000 you don't pay tax on, and the remaining is just ordinary income tax, the same as everyone else. And if you've been working in Thailand, this is something that foreigners, they don't always realize. If you've been working here and your employment is terminated, then you can receive Social Security because you've been paying Social Security every month. So you can actually receive that. I think it's for a period of 6 months. And if you resigned rather than your employment was terminated, you receive half as much for the period of time. That I don't recall if it's 6 months, but it's half the time, half the amount as you receive if you were made redundant. But you have to go down and wait for it, and queue for it at their office, which is quite time consuming, and it's not an enormous amount, but I think it's like 2,000 baht
because
a month
for the Social Security, the maximum salary that they calculate is up to 15,000 baht.
Oh, 15. So okay, so it's 7,500 if you resign and 15,000 if you're terminated every month. So that's something which I think a lot of people, they don't bother claiming for when they, if they leave their work. Oh, that's another one there. Timothy Wong, you asked us about the termination fee there, which Nam has just answered. And what's this one above it? Wayping.
One more message. Social Security Fund.
If you have any questions, you can unmute yourself and ask directly.
Yeah. Now that's true. I mean, there is some difficulty, but actually, if you go out to get a new visa and come back in again, you can still apply for the Social Security. Actually, it depends on the visa, though. If it's a tourist visa, they won't allow you. If it's another type of visa, it's possible. Like they might do.
What is the amount of days in Thailand?
This is in reference to what? Sorry. Yeah. Maybe if people like to email any additional questions that they might have, then we can get back to you. If you've worked in Thailand less than 180 days, you still have to pay tax on what you've earned on that. And if you've had a work permit, don't forget you're still considered to be Thai tax resident, and you still pay Social Security. So you can still split. Our email is. Should we just type it here? Is that okay?
I have the
okay.
So I
all right.
For the guy on IMF, we will get back to you later. Can you send us the email?
Yeah.
So your email is MBMG
info
on the screen. So info@mbmg-investment.com.
That's right. Okay. All right. Well, thanks very much, Jen, for hosting this for us.
All right. Thank you so much, Paul, James, and Kun Nam for sharing your knowledge and expertise and answer a lot of questions from the floor. I know it's a lot of. There will be more questions on your way from the audience. Again, so this is our first webinar events of the years, and the first event that we host with the MBMG as well for this year. Okay, I would like, apart from this, I would like to thank you, our annual partners, ISB, Bangkok Hospital, Magna Automotive, for your trust and continued support for CanCham Thailand. Again, so we have the we have already rescheduled our events, which is on April 28th, like Crystal Ball Business Luncheons, and also on May 12th, Women in Leadership is one of the flagship event of CanCham Thailand. We have the great speaker coming up, women entrepreneur, women leaders, and you can find more details on our website. And again, thank you so much for your time. Thank you all participations. Thank you, James. Thank you, Kunam again. I hope to see you guys on the next events that we host. Thank you.
Great, thank you. Thanks a lot.
Thank you. Bye-bye.
Bye.
Bye-bye.